Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing grocery outlet stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 2.2 billion market cap. They're trading at $22 a share and they have 100 million shares outstanding. The market cap and stock price are identical, 2200, both of them. Go operates as a food retailer through independently operated stores in the US. Its stores offer products in various categories such as dairy and deli, produce, floral, fresh meat, seafood products, grocery, general merchandise, health and beauty care, frozen food, beer and wine, and ethnic products. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. Look how much their free cash flow grew in 2023, almost tripled, 111 million, but it came back down in the trailing 12 months to 23 million. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's really steady, between 60 and 80 million. Really low margins, they convert only 2% of their revenue into net income. Revenue is the sales for the company, and that grows each year from 3 billion to 4 billion. Nice steady growth. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 100 million shares. And we get a calculated stock price of $24. They're trading at $22, so they're trading at an 8% discount. It's a buy according to the model. I am assuming they're going to have pretty good free cash flow growth in the future. In the past, it's okay because it's positive, but you would hope to see an increasing trend. They went up then down. There are 12 companies in the same industry as Go, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, 180 million. A pretty good debt to equity ratio, 1.1. Weiss Markets is number 1 at 0.1. They do not pay a dividend, only 23 million of free cash flow. They rank 5th in market cap. Price to book is 1.8, better than the median average. They're trading at 34 times earnings, 95 times free cash flow. The worst on this list. Also the worst PE on this list. Price to sales is 0.5, which is worse than the median average. They generate 4 billion of revenue, less than the median, but they're growing the most. Their 5-year annual revenue growth rate is 12%. If you put $10,000 into this company when they started trading, you would not be happy, down 22%. That's a 5% annual loss. It's definitely up and down, the stock. It was up for a while, then came down, then a nice big run up, but lately it's been coming down again. Could be a great time to get in, especially if there's a big run up. Let's take a look at their financials. Here's their income statement. First quarter 2024, first quarter 2023. Sales are up from under 1 billion to a little over 1 billion. Let's get a breakdown of the sales so we know what it is. The only breakdown they provide is perishable, 380 million, non-perishable, 650 million. And it's up in both categories. Perishable includes dairy and deli, produce and floral, fresh meat and seafood. Non-perishable includes grocery, general merchandise, health and beauty, frozen foods, beer and wine. When someone buys a gift card, that's a liability for the company. They mention it right here. We record a deferred revenue liability when a gift card is sold. Revenue is only recognized when the gift card is redeemed. So when someone uses the gift card, then the company removes a liability and books revenue onto the income statement. Gift cards are usually redeemed within 12 months. Some are never redeemed. Periodically, they reduce the liability and recognize revenue for unused gift cards. That's called breakage. The definition of breakage is revenue gained by retailers through unredeemed gift cards. So the company pockets the money paid for the gift card without actually providing the service. All the money is considered to be profit for the company. But for accounting purposes, this has been a recurring problem throughout the years. The reason it's a problem, some companies have been accused of inflating their revenue figures with breakage, because breakage is an estimate. In 2006, it was estimated consumers lost over $8 billion due to breakage. That's a lot of wasted gift cards. In case you're unsure what I'm talking about, this example will drive the point home. If somebody buys a $50 gift card from a company, the company receives $50 in cash, and they have to book a liability, a future liability for $50. Let's assume it was a Starbucks gift card. The person used $48 on the card and then threw away the card. They never used the last $2. So the company would remove $48 from its liability and book it as revenue. The leftover $2 is considered breakage. So at some point, the company would book the $2 as revenue. This company has $2.3 million of deferred revenue as of 3/30/2024. We could find that on the balance sheet. Sales went up 7.4% when you compare 1Q 2023 to 1Q 2024. It's a $71 million increase in dollar terms. And they mentioned the increase is due to 30 new stores they opened. Comparable store sales increased 3.9%. That's probably pretty close to inflation. That was driven by a 7% increase in the number of transactions, offset by a 2.9% decrease in the average transaction size. So there are more customer transactions, but each customer spends less money when you compare it to last year. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue, $730 million. Cost of revenue went up 10% when you compare the two quarters, an increase of $68 million. Revenue did go up more than cost of revenue, but you have to look at percent. The percent of revenue went up less than the cost of revenue. Therefore, their margins went down. That's right here, the gross margin. Gross profit is revenue minus cost of revenue. It went from $300 million to $303 million. So it went up $3.4 million, went up 1.1%. But you can see their gross profit margin went down from 31 to 29. They have the same footnote. The increase in cost of revenue was due to an increase in comparable store sales combined with the expenses from their 30 new stores. Cost as a percent of revenue increased mainly due to inventory management impacts related to system upgrades, as certain tools we use to manage the business on our legacy system are taking longer to rebuild, which have impacted data visibility. It always seems like they're dancing around words. Just get straight to the point. Let's go back to the income statement. Below gross profit is SG&A. Those two numbers are almost identical, so they have a very small operating income, only $500,000. Last year was $33 million. Their SG&A increased 13%. Last year it was 28% of their revenue, now it's 29%. The increase was driven by $23 million higher in store-related expenses and $13 million higher in corporate-related expenses. There was higher commission payments to IOs, independent operators. There were corporate expenses like the acquisition of United Grocery Outlet. More marketing expenses due to a change in the timing of our spring wine sale and increased corporate-related depreciation and amortization. Grocery Outlet, the parent company, does not operate the stores. IOs, independent operators, run the stores. As of the end of the first quarter, they had 474 stores in California, Washington, Oregon, Pennsylvania, Idaho, Nevada, Maryland, New Jersey, and Ohio. They spent $3.2 million of interest on their debt. Last year, $6 million. The decrease in the interest expense was due to a decrease in principal debt outstanding, combined with increased interest income from higher interest rates on our cash and cash equivalents. Because a lot of the cash they have, they invest in short-term liquid assets, like commercial paper or corporate bonds. The interest they pay on their debt minus the interest they receive on their cash is interest expense. Some companies actually have a profit in interest expense if they don't have much debt or they have a ton of cash on their balance sheet. An income before tax loss of $2.6 million, an income tax benefit of $1.6 million. Last year they paid $7.8 million of taxes. They talk about it right here. We recorded a net income tax benefit of $1.6 million. This is due to a pre-tax book loss combined with excess tax benefits related to the exercise of stock options, partially offset by non-deductible executive compensation. So the main reason they had a tax benefit is because they had a loss this period. A net loss of $1 million compared to a gain of $13 million last year. They're adding shares. Last year, 98 million. Now it's almost 100 million shares. If you want to get more detail on the shares outstanding, you should look at the consolidated statement of stockholders' equity. In December 2023, they had 99 million shares outstanding. They raised $900 million from issuing new stock. During the first quarter, employees exercised stock options, which added 1.1 million shares. They bought back 201,000 shares, so their total shares went up from 99 million to 100 million. And their equity went up a little bit, 1.22 billion. You could see this number on the balance sheet, 1,224,573. It's right here in equity, 1,224,573. Equity is assets, 3 billion, minus liabilities, 1.7 billion. 1.2 billion is the value of the company according to the balance sheet. And most of their equity is additional paid-in capital, 900 million, that's how much they raised from selling stock, plus retained earnings, 340 million. That's how much money they made from running their business. It's a sum of all their prior net incomes. Let's look at a statement of cash flows. So even though they had a net loss in the first quarter, they still generated positive cash flow, only $8 million though. Last year was 87 million. The reason they had positive cash flow and negative net income is because of depreciation. This is an expense that brings down your net income, so it makes your net income look bad, but it's a non-cash item, so we add it back here. And then there were other changes as well. They give a little more info on the statement of cash flows. This is just a summary. So you can see operating cash flow 8 million, last year 88 million. It went down 91%. The decrease in operating cash flow was mainly driven by merchandise inventory levels and accrued expenses combined with lower income. Here's their statement of cash flows. You can see merchandise inventory that a cash outflow of 13 million. Last year was a cash inflow of 18 million. And accounts payable that a cash outflow of 17 million. That's what they were talking about. In the investing section, they spent 46 million on CapEx. These are the investments in property, plant, and equipment. So they had a cash outflow of 51 million in their investing section. Let's see what they say about their investing section. The increase in net cash used in investing activities of 10.5 million was due to increased spending on property and equipment due to higher store count and construction related to future stores. So as they add more stores and have to build stores, that increases their CapEx. In the last section, the financing section, they received 3.4 million from the exercise of stock options. They paid 1.9 million towards a loan due in 2028. They spent 400,000 in finance leases, and they repurchased 6.2 million of common stock. We saw that in a statement of changes in equity. Let's see what they say about the financing section. It was due to the repurchase of 5 million of common stock and 1.9 million in scheduled principal payments on the senior term loan under the 2023 credit agreement, partially offset by 3.4 million in proceeds from the exercise of stock options. Let's look at a stock on Simply Wall Street. Its last price 2.2 billion market cap. It's up 4% in the past week, but down 28% in the past year. It started trading in 2019, I think around 25 bucks a share, it's hard to tell. And over the next 2 years, it went up and down, but came back pretty close to their IPO price. It fell to 21 in October 2021, and then 9 months later it doubled from 21 to 45, more than doubled. That was its highest point ever, never got that high ever again. So from June 2022 to May 2024, the stock fell more than 50%, its lowest point ever at 1977. If you like this stock, it's a great time to buy, because I don't think there's that much downside left. It seems like there's a lot more upside than downside. On the other hand, Simply Wall Street's valuation is $4. They say it's really overvalued. I wasn't expecting that. Most stocks are undervalued on Simply Wall Street. The analyst estimate is 26, and this purple line is the analyst estimate, so it's at its lowest point. The estimate was much higher 1 and 2 years ago. The analyst estimate was $46 in August 2022. Revenue is projected to grow each year up to 5.2 billion by 2026. The free cash flow forecast is projected to be negative this year, then back to positive in 2025, positive 40 million. This red line is their debt, and their debt was higher than their equity, but now their equity is much higher. Equity of 1.2 billion, debt of 300 million. And this green line on the bottom is their cash, 67 million of cash. The CEO's salary went from $500,000 to over 900,000. Total compensation $6 million, tenure as CEO 5.4 years. In the past year, lots of insider buying and selling, pretty close to the number of shares bought and sold. Only 3 buy orders, but one of them was for 100,000 shares. So that's why the total number of shares is pretty equivalent. It's right here, about 170,000 shares sold, about 150,000 shares purchased. 96% of the company is owned by institutions, 4% by insiders. The LA company Capital Research is the biggest shareholder at 12%, then Vanguard, then BlackRock. Jackson Square in San Francisco owns 3%. The previous CEO owns 2.5%. JP Morgan, BNY. And they don't employ that many people because they don't operate the stores. Most of the stores are operated by their IOs, independent operators. It's not a franchise. There's some similarities, but it's not a franchise. So they went from 800 employees to 949, and the ticker trades in one place, the NASDAQ. Let's learn about the history of the company. James Reed founded the company in June of 1946. He bought government surplus food products and sold them in previously vacant stores throughout San Francisco. He named his new company Cannery Sales. In 1970, Cannery Sales acquired Globe of California and renamed it Canned Foods. In 1971, Canned Foods signed agreements with Del Monte, Conagra, Quaker, and Revlon. He opened his first store in Redmond, Oregon in 1973. After James's death, his sons took over the business. In 1987, they renamed it Grocery Outlet. By 1995, they had 100 stores open. In 2001, Grocery Outlet acquired all remaining liquidated inventory of Webvan. After that company filed bankruptcy. Also in 2001, they acquired Wine.com's remaining inventory, following their bankruptcy. A lot of the company's inventory comes from overstocks and closeouts of name brand groceries, also private label groceries. Grocery Outlet buys mostly closeout or seasonal merchandise. That's why their products change a lot. The company's stores also carry food staples such as fresh meat, dairy, and bread. One of the most popular sections in the store is NOSH, Natural, Organic, Specialty, and Healthy. This is how Grocery Outlet has attracted followers who want to buy ethical items, such as vegan or plant-based, and save money by doing that. So that's the end of the video. Subscribe or comment below. Thanks for watching.